As the U.S. market is not yet open for the October 22nd, 2025 session, we are looking at the closing figures from yesterday, October 21, 2025. Plug Power Inc. finished the session at $3.12 per share, a sharp decline of $0.28 or 8.24%. That 8.24% drop is the market's immediate, visceral reaction to the story behind the story. While many retail investors, perhaps doing some self-investing on the Robinhood app or through SoFi Invest, were celebrating the stock's incredible 37% surge back on October 3rd and the subsequent run to a 52-week high of $4.58, the other shoe was preparing to drop. And that drop wasn't just market dynamics, it was the sound of the company's treasury opening up. The reality that hit the market wasn't about hydrogen production, it was about a massive and complex capital raise announced on October 8th through a warrant inducement agreement. This move secured $370 million in immediate gross proceeds, but it came with a catch. New warrants that, if exercised, could pull in an additional $1.4 billion. For a stock with a market cap hovering around $4 billion, this represents a staggering potential dilution, and yesterday's 8.24% slide is the market repricing that new reality. The expectation for Plug Power, the narrative that has kept it one of the most talked about names in the clean energy space, is perfectly clear. This is supposed to be the company that finally cracks the green hydrogen code at scale. We all saw the headlines. On October 3rd, analysts at H.C. Wainwright reiterated a buy rating and slapped a street-high $7 price target on the stock. This wasn't just optimism, it was fueled by tangible operational news. The company announced record production levels at its flagship Georgia green hydrogen production facility, which apparently hit 97% uptime in August. Just this week, on October 21st, Plug announced the successful completion of hydrogen deliveries for the H2CAST project in Germany, a critical step in proving its capability to supply hydrogen for large-scale storage in European salt caverns. They also delivered a 10-megawatt electrolyzer array to Galp's Sines refinery in Portugal. This is the stuff bulls dream of: real projects, real production, and expansion into the critical European market. This is the story that makes an investor using Fidelity or Interactive Brokers look at the long-term chart and believe they are getting in on the ground floor of the next energy boom, a speculative play completely different from holding Apple stock or Nvidia stock. But the reality, as it so often does with Plug Power, is far more complicated and hinges on one terrifying word: liquidity. That $7 price target from H.C. Wainwright stands in stark contrast to the consensus analyst rating, which remains a hold. In fact, the consensus price target is hovering somewhere between $2.29 and $2.36, meaning that on average, Wall Street analysts believe the stock, even after yesterday's drop, is still overvalued. While H.C. Wainwright sees a green hydrogen giant, other major firms like Morgan Stanley and Piper Sandler have underweight ratings. They aren't looking at the new German contracts, they are looking at the company's relentless cash burn. This is the central tension of investment in Plug Power. You are not just betting on the technology, you are betting on the company's ability to fund that technology's rollout without bankrupting itself or diluting existing shareholders into oblivion. Let's dissect the recent timeline because it perfectly illustrates this expectation versus reality whiplash. The stock spends most of the year in the doldrums, fighting to stay above $1. Then the operational news starts to hit. The Georgia plant is scaling. The One Big Beautiful Bill, which solidifies crucial tax credits like Section 45V, provides a legislative tailwind. The stock begins to climb. The October 3rd news and the $7 target from H.C. Wainwright act as an accelerant, triggering a massive short squeeze. Remember, Plug Power has had short interest hovering above 30%, meaning a huge number of institutional players, likely using sophisticated interactive brokers trading platforms, are betting heavily against it. When the price rocketed up, those shorts were forced to cover, pushing the stock up nearly 37% in a single day and carrying it to that $4.58 high on October 6th. Retail investors using Robinhood stock trading piled in, chasing the momentum. Then, at the peak of the euphoria, the company acted. On October 7th, Plug announced a major leadership transition. Andy Marsh, the long-term CEO, would be stepping down, moving to executive chair, and be succeeded by Jose Luis Crespo, the company's head of sales. The market barely had time to digest this shakeup when just one day later, on October 8th, Plug announced the warrant inducement deal. This is where the story turns. A warrant inducement isn't a confident at-the-market offering. It's a complex deal, in this case with a single institutional investor, to exercise existing warrants now in exchange for new, repriced warrants. It is, in plain terms, a move made to get cash in the door immediately. This $370 million and the potential $1.4 billion more isn't for a shiny new acquisition. It's to fund operations. It's to stop the bleeding. The market, which was high on the hydrogen hype, suddenly realized the company was more worried about its balance sheet than its next press release. The stock began its steady descent from $4.58, and yesterday's 8.24% drop was just the latest painful chapter in that new awareness. This is why analyzing a stock like Plug is so different from looking at Tesla stock or a blue chip in a Fidelity mutual fund. With Plug, the financials are the story. Let's look at the Q2 '25 results reported back in August. The bulls will point out that revenue climbed 21% year over year. More importantly, the gross margin, while still horrifyingly negative, improved to negative 31% from negative 92% in the same quarter last year. Net cash used in operating and investing activities declined over 40%. This is all part of Project Quantum Leap, the company's internal initiative to cut costs, aiming for over $200 million in annualized savings. This data shows they are trying to right the ship. But the reality is that the gross margin is still negative 31%. They are still losing an enormous amount of capital on every single thing they sell, even as revenue grows. This is the classic high-growth trap, and the recent warrant deal proves that Project Quantum Leap alone is not enough to close the funding gap. They need external cash, and they need it now. This is a level of risk that automated investing sites or a service like Schwab Intelligent Portfolios is designed to avoid completely. This is pure, high-stakes speculation, better suited for an active trader using the Fidelity trading platform or interactive brokers, not someone looking for simple online investment help. So, what does the company actually do? For years, its primary business was building hydrogen fuel systems for material handling equipment. Think forklifts in warehouses for customers like Amazon and Walmart. This is a steady, established business. But the stock's valuation isn't based on forklifts. It's based on the total green hydrogen ecosystem they're trying to build. This includes manufacturing the electrolyzers, their Genico platform, building the plants, like in Georgia and Louisiana, that produce the liquid hydrogen, and then handling the storage and delivery. They want to be the one-stop shop for the entire hydrogen economy. The deals in Portugal and Germany show the electrolyzer business is gaining traction. The Georgia plant's record production shows they can make the fuel. The problem is that building this vertically integrated ecosystem costs billions of dollars, and Plug Power doesn't have billions of dollars. It has a high cash burn rate and a stock that it now needs to use as an ATM through dilutive offerings like the one on October 8th. This brings us to the future outlook, which is a perfect split between expectation and reality. The bullish expectation, the one that supports that $7 price target, is that the October 8th capital raise was the last big one. That the $370 million, combined with cost cutting from Project Quantum Leap and the ramp up of their new, more profitable production plants, will be the bridge that gets them to positive gross margin by the end of 2025 or early 2026. In this scenario, the new CEO, Jose Luis Crespo, who comes from a sales background, is the perfect person to take the helm and focus on commercializing all the technology Andy Marsh built. The operational announcements, Georgia, Galp, H2CAST, are the real story, and the